Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London, UK feed wheat. Paris milling wheat. In mid-November last year, the market broke down and out of the combination of the mid-September to mid-November 2023 descending triangle, as well as breaking below the neckline, which is currently at 234, of the June to November 2023 head and shoulders top. In the process, the market created two new gaps, small ones, between 216.5 and 217, and between 212 and 3/4 and 213. So let's look now at the June to November 2023 head and shoulders top. Now, I've been frank in stating my view 10 weeks ago and ever since, when I said, and I quote, "I'm not necessarily comfortable with the head and shoulders pattern, but I still feel obliged to indicate potentials for this pattern below." Thus, a primary target X2 is in the 215 zone, with a secondary harder to reach target X3 down below the bottom of my daily chart in the 197 zone, end of quote. Both these two targets, harder to reach or not, have been achieved in recent weeks. This leaves me with one big picture item that I will bring to your attention once again. So, as part of this move lower, I would like to once again discuss the previously oft-mentioned very big bear channel, currently 229 to well off the bottom of my daily chart. This bear channel is highlighted in dark blue on my daily chart and originates from June and October 2022. So it's coming up to 2 years ago. It is right and appropriate to consider this big picture item in the light of what we have recently seen. Yet there is one more item, another that I had previously discussed and something I drew 3 weeks ago. I said about this pattern 2 weeks ago, and I quote, "One that is not completely satisfactory, but which I would still like to bring to your attention, is the early November to mid-December 2023 bearish Andrews pitchfork. It is far from perfect, broken almost immediately. However, the market has shown a strong inclination to hang around the declining upper time, highlighted in bright red on my daily chart. That's currently at 186. I would like to retire it, but it's not working as it should. But then again, who am I to deny that the broken upper time is indeed showing the bearish angle of attack of the market?" End of quote. Well, that was then, and this is now, and this past Monday the market created an unusual key reversal up just before changeover, and a subsequent gap from Monday to Tuesday that signaled the end of this bright red bearish Andrews pitchfork, the beginning of something new. So I will retire this pitchfork after this commentary and start looking for the next feature that will show the direction of the market. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had usually been somewhat easier to read in the past with respect to what was going on and what the opportunities might be. For a while this seemed no longer true, but recent actions seem to have brought the market back into clearer line. So, back in late February 2023, and especially at the start of April last year, so almost a year ago, so that is now outside actually the parameters of my daily chart, but just bear with me. The market constructed a large bear channel that morphed into what we now see highlighted in dark blue on my daily chart. A descending, expanding wedge pattern, currently 756 to down to well off to bottom of my daily chart. The upper trend line is currently escorted and reinforced by the declining long moving average, currently 761. Then in early December last year, the overhead declining short medium moving average, currently at 686, highlighted in dark green on my daily chart, started capping prices. In truth, this moving average had been an effective cap on the market since mid-October 2023. Not tested, but effective nonetheless. At the end of December, prices gave up testing the overhead short medium moving average and headed lower, finally punching through the support, which is now resistance between 693 and 708, dropping down to the August 2018 high at 650 and a January to March 2021 congestion zone. Yes, a congestion zone from 3 years ago. A congestion zone between 625 even to 650 even, approximately, which is where we are now. This also fits in with 3 other parameters I'd spotted, nestling like Russian dolls one within another. 19 weeks ago I said the following of the first pattern, and I quote, "It is the nascent late August to date bear channel, highlighted in bright red on my daily chart, currently 581 even to 720. This pattern is still operational, and once again I note how we have a smaller bear pattern nestled within a much larger one, much like a Russian doll." End of quote. This pattern is still alive, though we've not really had any tests of it, below or above. The next pattern is highlighted in purple on my daily chart and is the October 2023 to date bear channel, currently 628 to 729. This one has seen some touches, and the market has recently been close to the lower trend line, touching it 2 weeks ago, but rejecting it back up. I would also note here how the upper trend lines of both patterns are quite close to each other, thus mutually reinforcing each other. Plus, we also have the declining medium moving average nearby, adding further to the reinforcement. The final one is the most recent and is the late December 2023, late January 2024 bearish shift pitchfork. A pitchfork inspired by the actions in Chicago wheat. For the last 4 weeks, prices have been testing and penetrating the lower time, highlighted in bright green on my daily chart, currently at 633, seemingly without any result. And test that without any avail. We even saw the market this week pop up to the upper time and test that again without any avail. Right now we are sitting just underneath the middle time, which is currently at 650. I'll finish today with my final thoughts from 2 weeks ago, as they are still valid, and I quote, "All these patterns are bearish, and they give varying opportunities depending on what time horizon you would be interested in. For the moment, continue to keep an eye on that 3-year-old congestion below, between 650 to 625. End of quote. London UK feed wheat. The move higher from the May to July 2023 double bottom pattern reached its climax in mid to late July last year. Since then, prices started moving lower and eventually sideways. Then recently lower again, and most recently sideways again. Interestingly, one of the key features here, and it is a surprising feature, has been the extension of the neckline of the May to June 2023 reverse head and shoulders bottom, currently 189.05. This was not a very notable pattern, a mini reverse and shoulder pattern if you will, but the extension of the neckline first acted as a pretty reasonable support and then later as an additional resistance. Though I had suspected in the background the September 2021 low at 181.70 and perhaps more importantly the 50% absolute Fibonacci line at 180.5 had helped in the past to prop up prices, and now this year to cap prices instead. In the bigger picture, there has been the beginnings of a possible pattern development since mid-February, a possible double bottom, though the action late this week is not supportive of such a pattern, not yet at least. At the start of 2024, we saw prices fall through support and then 7 weeks ago reinforce that move lower with a weekly key reversal down, confirming the bearishness, dropping down through old congestion from March to April 2019, yeah, that long ago, March to April 2019, between 161.95 and 165.75, as well as the July 2021 and May 2023 lows, both at 164, the August 2020 low at 161 even, the June 2020 low at 156.95, after which prices started to halt their descent, ahead of the May 2020 low at 149.95. Now further down we have the April 2020 low at 148.45 and also the March 2020 and 2020 as a whole low at 145.45. This last support seems more interesting as it's within an old piece of congestion dating from between 2016 to 2018, between 147.75 and 136 even. Now I've already mentioned a possible new pattern of a double bottom formed since mid-February. What is preventing that pattern is the combination overhead of the previously mentioned congestion between 161.95 and 165.75, as well as the August 2020 low. Right now it looks like a possible double bottom in formation, but if these nearby overhead resistances are as good as they seem to be right now, then this possible double bottom could turn out to be a possible rectangle pattern or even a possible bearish half hesitation. It is too early to say on these latter two ideas just yet, but I thought you should be aware of all the possibilities, especially if the market fails in its recovery. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Service International Limited. And here comes the final important bit.